Just, every time she walks by me, I act like I'm talking on the phone, so she won't say, "Turn the AC up." It costs money.
I believe Tony's joining us, right, Mike? I think he's.
I would think so. I don't know that. Nope.
I think we're waiting for Jason too.
He's done. It's there.
Mike, have you had a chance for me to introduce Ed Rutkowski, who you see joined us, who's our interim CFO?
I have not.
Okay. Ed, as a longtime hired administrator, was the CFO and VP of administration at the Pratt Institute for over 2 decades, and now moonlights, and we're thrilled to have him. We've been under search for a CFO, and actually have finalists that we're bringing to campus and over the next couple weeks. So so Ed's been quite ably holding the fort for us.
Okay, good to meet you, Ed.
Oh, nice meeting you as well.
Danae, who else are, and we're a couple seconds away. Who else are we waiting for from the trustee side?
I don't know if Mary Kate, and then we just added Maurice. I hope he didn't get confused with the time. Maybe the habit of starting at 5, but that's about it.
I don't think Mary Kate's going to join us. I know that she was checking to be sure that we had trustee representation. Yeah.
So I know I sent the link out. So
Right, you did. Yep. We'll give him a couple seconds.
Jason, have you met the team from FIA? And I don't believe you have.
I don't think so, no.
Mike Chase from FIA, and there's Tony. He's coming on from Wells Fargo. And this is Jason Cohen, our Senior Director of Finance and Budgets.
Okay, good to meet you,
Nice to
Jason.
meet you.
Yeah, unfortunately, I don't have Maurice's contact info.
Hi, Tony.
yeah, I'm sending him a text right now.
Okay, great. Thanks. We'll give a couple more seconds then. Hey, Tony, how are you?
Good. How you doing?
Good. We'll get
Tony,
started
thanks
here in
for
a couple
joining
minutes.
us. Yeah, I hope you're doing well.
You too.
Where is this? Jason, go over, okay?
Any reaction at all from Maurice? And did you get a response at all from Maurice? Oh, you must be on mute. I can see you talking, but I can't hear you.
No.
Still can't hear you. Yeah, no, I can hear you now. Yep.
Okay, it takes time. I don't know what happens to my mic, but it takes a little bit of time. But no, I'm waiting, and it's odd because he's always on time. So I text him, and he received the link and responded. But
Okay. You know, why don't we get started, and so he'll join soon. So
yes.
why don't we? I'll call the meeting to order here, and maybe you want to take a roll
Yes. Max Starks,
here.
Maurice, and Mary Kate.
Great.
Thank you.
Thank you, and I
Thank you.
appreciate that. So with that, Michael, if you can start taking us through.
Okay, let me share my screen here.
Mhm.
Can everyone see that okay?
Yes.
Okay, so we'll go through the third quarter materials. Obviously, a lot has changed since September 30th, which I'll try to overlay as I normally do when we have these meetings, right? But we'll walk through the governance calendar and the capital markets update and give you an update on where the portfolio stand and say generally pretty favorable news in a nutshell. From a governance standpoint, this quarter, our focus is on governance. So that typically is a policy statement review and just best practices for investment committee. You'll see the best practices outlined here. I won't read through each one of them, but it's good just for those serving on the committee and just participating, it's good to kind of get a sense of what roles and responsibilities are to be a prudent fiduciary on the assets. From a leadership perspective, makeup of the committee, meeting attendance, minutes, et cetera. So just good to peruse that and familiarize yourselves and make sure we're doing all those things. And then maybe more importantly, the policy statement, which governs everything that's going on in the portfolio and what we manage within. We review that once a year just to make sure it stays on objective and there's no recommendations for change. So that's the case this year. You'll see just because there's X's doesn't mean it's necessarily a bad thing. It's just not included. So we don't have a spending policy on those pools. We don't have a lot of illiquid assets that we need to deal with. So we don't really have those guidelines there. And then they're all mutual funds and commingled funds. So the managers are voting those proxies. So really nothing to add and no recommendations for any change, but the document is in the materials. I think it's a good document. And again, I just encourage members to review it at their leisure just to make sure that they familiarize themselves with what's going on underneath the hood of the program. Last thing from a governance perspective, or actually maybe I'll just touch on this, and Dorothy and I have been having these conversations. So this time of year is the time of year where we structure the pools to determine how much is in the long term versus short term. I won't go into the details, Dorothy can, about just historically what the calculation has been about what needs to go into the long term or into the short term pool. We have it through fiscal year 2018, it was 74 long term, 26 short term. Or excuse me, 2018 is on there, 2019 is below it in yellow. We have not updated that for 2020. I know there's some unique considerations right around COVID and operations and whatnot. So I don't know, Dorothy, if there's anything to mention here for that, but we are working on that.
Yeah, absolutely. Trustee Starks, while you're here, I just wanted to run this by you. So as Mike said, our portfolio structure strategy has been such that we take that unrestricted net position per our audited financial statements, and we adjust it for the GASB 68 and 75, those transactions that are basically state transactions that we're required to put on our financial statements, but that we won't be held liable for. So we take that amount and we reallocate that to the long-term pool. So bottom line, this year, that would mean putting $15.4 million towards the long-term pool. So as of right now, we have, as of the September 30th statement, we had about 16 million. So that would leave just about shy of $1 million in short term. So given the uncertainty of, what might happen in the spring, given possible needs, we thought maybe we might want to make a recommendation to only put $1 million in the long term at this time, and maybe revisit it in the spring once we have a little bit better idea what's going on with spring enrollment. So just wanted to get your thoughts on that. And maybe
I'm sorry, go ahead.
With a possibility of revisiting, and possibly putting more money in long term if things turn out.
Yeah, so given our discussion yesterday with $3 million excess coming out of our fiscal 2020 financials, what do we expect our total portfolio investment to be? Because I'm comfortable with about $4 to $5 million in short term, so only having $1 million. I mean, that what you described with Gatsby and all that may have been the basis for an approach in the past, but from my perspective, having about $4 to $5 million on I'll call it on hand, is more important to me than following kind of what you described. Yeah. So whatever that looks like, that's why I'm curious what the percentages will be, because I think that $15 million is going to be much higher than that, right? And the
so Mac, this is where it sits as of 9/30. So it's about 16.5 total. There's about 11.6 in the long term and 4.9 in the short term as of September 30th.
Right. Okay. So that split I'm comfortable with. So whatever we need to do to keep that, keep about $4 to $5 million, call it 4.5 to $5 million in short term, then that's the approach I want to take.
Okay. So I'd say if you're comfortable with the current setup, there's no need to adjust it. We can kind of formalize the policy just to make sure that we went through the formal process this year and kind of note the exception just for the records. But other than that, there's really nothing to do from a portfolio structure standpoint.
Excellent.
Very good. Thank you.
Thank you.
Okay, any other questions on governance materials? Otherwise, we'll jump over to what's going on in the capital markets. Okay. So again, this is through September 30th. So third quarter, the dark blue line is the price return of the MSCI All Country World Index, so a basket of global equities. And you can see that it was a pretty positive quarter, ended up close to 8%. A lot of things going on, mostly centered around the election and COVID, which is probably pretty self-explanatory at this point. But you can see we actually were up close to 14% through the tail end of August. And we saw some volatility come back just as there were some concerns about increasing COVID cases. And then obviously, as the election was drawing closer, it tends to be a pretty volatile time with uncertainty. So generally a positive quarter for risk assets. Interest rates were relatively unchanged, so the ag was very slightly positive. Spreads did tighten in pretty dramatically, and we'll touch on that in its role in the portfolio here in a minute. But generally, anything with some incremental yield above a treasury bill did quite well. High yield, investment grade, corporate, securitized, all were additive, and we definitely have a tilt toward that in the portfolio. That was a headwind in the first quarter, but has been a nice tailwind for the remainder of the year. And we still feel strongly in that posture going forward, just given the low level of interest rates. The S&P was up 8.9, which brings it up 5.5 year to date. I'd say that's a little bit of a misnomer about kind of the strength of the broader U.S. equity markets, because it really has been the tale of a few haves and many have-nots in the recovery. So some of those large tech names that we talked about last time we met have continued to rally and have really driven essentially all the return of the S&P, the FANG stocks and Microsoft. And you can really see the dispersion between the growth and value side here. Russell 1000 growth up 24% for the year. Russell 1000 value down 11.5. So very big dispersion between the value side and the growth side, mostly driven by those technology names. And that kind of theme permeated across mid-cap markets, small cap markets, and international markets. It's been a tough time for value. Although I'd say quarter to date, we started to see that recede, and meaningfully so here in November. Yesterday, value experienced dramatic outperformance over the growth side, close to 600 basis points in a day. So I'd say that that's not overly common, but we do have that value tilt on the portfolio because that dispersion is so wide. Obviously, it has hurt results on a year-to-date basis, but starting to, again, revert a little bit in longer term. We'd expect those to continue to come in line with each other. So trying to be thoughtful about not chasing some of those high-flying growth names. And then the alternative side still stay relatively muted. Both REITs and energy have had a tough time. They're two areas of the market, the economy, that people are particularly nervous about the impacts of COVID just on commercial real estate and energy demand in general. They both did quite well again yesterday and really quarter to date, but through the second quarter anyway, it's been a really tough place to be allocated. From an economic standpoint, we're generally seeing economic data recover, kind of on trend with where most folks expected it to be. PMI data has moved back above the 50 mark, which means it's in expansion territory. It's a pretty good indicator. We saw estimates for US GDP and other GDP marks around the world, as high as they've ever been for a quarter, but they have a long way to recover from what we experienced in Q1. So kind of on trend with where folks have expected them to be. Forecasts are still for GDP growth in 2021, which we argue the market has priced in. Still a lot of uncertainty out there, right? If you think about where things have changed since September, it appears that Biden won the presidency, although I don't know if that's signed, sealed, delivered, and certainly some fighting to do before we're beyond that. It looks like the Republicans held on to the Senate, or at least that's what a lot of people are inferring, which kind of would limit maybe some of the Democratic stances from getting pushed through all layers of government on a very rapid basis. And it tends to be that markets perform better when the government's split. So we'll see how that plays out. Obviously, the news yesterday around what appears to be a pretty valid COVID vaccine with 90% efficacy has a dramatic impact on all this. But kind of lever all that stuff on top of what's meaningful growth in COVID cases to be determined about what the reaction is in terms of lockdown and economic impact of that moving forward. So a whole host of uncertainty that still remains out there. I think the market has priced the expectations close to perfection. And if we start to see any disconnect from that, could kind of spike another bout of volatility here. So not necessarily calling for that, but not ready to say that we're kind of out of the woods yet and ready to move on totally from this. So still, I'd say cautiously optimistic. From an equity standpoint, because markets have been so strong, you can see here in the US, we're at valuation levels which actually are above 2019 where we ended 2019, with earnings down slightly in some circumstances, then prices up. You'll see how far out above that is even from median and even one standard deviation in terms of history, in terms of where US equities are priced. Again, there's a little bit of divergence here, right, between some of the high growth names you see and some of the value names, but on the whole, things look pretty frothy. International markets, I wouldn't say that are excitingly cheap, but certainly on a relative basis appear more attractive. And from a contribution to sector return, continues to be driven almost exclusively by growth sectors. It's a little bit more diversified this quarter than last quarter, but technology, which is 28% of the index, still contributing over a third of the total return, and then add in some of the other growth sectors, really where you're getting all your return from. On the fixed income side, valuations arguably as stretched, if not more, to end the quarter. They were up a little bit. We were down in the mid 50s at one point on the 10-year treasury. It bounced back to about 70 basis points. It actually opened today at around 95 basis points. We've seen rates increase pretty rapidly here in the last week and a half. But regardless, those are still pretty muted. Those are nominal return expectations, essentially looking forward 10 years. Adjust that for inflation, and it's either flat to maybe even modestly negative still. So continues to be a big headwind for a long-term investor, which is why we've tilted the portfolio toward thoughtful spread and credit exposure. And we were rewarded for that in this quarter. You'll see the light blue bars are the excess return from the spread sectors over treasuries. You can see that it's pretty meaningful. And that was all driven by this little blip right here. This is when spreads gapped out in March alongside the equity markets, and the fixed income markets went almost illiquid. You can see they've tightened in pretty dramatically, which made for a nice opportunity to add credit exposure here, which we did in the portfolio. And I'll tell you about that in a minute. We added that PIMCO high yield strategy at about when spreads were about 850 basis points. And when they dropped below 500, we actually took it off. So it happened a lot quicker than we thought, but it would generate about a 9% return in about 2 months. And because we're back down into these historical averages, we took that additional credit exposure off. So we're still tilted that way, but not quite as much as we were through the summer when we were really benefiting from it. From a theme standpoint, not a whole lot has changed. Volatility is up. We expect it to stay that way. Growth continues to just crush every other equity market, whether it's the broader S&P, foreign markets, small cap, you name it. Large growth has been the place to be. And as a result of that, that dispersion again between value and growth is at a level that we've really never seen before in history. I'll skip over the election stuff because this is stale at this point. It's just talking about volatility going into the election and ultimate outcomes. I think, as I mentioned, there is still a lot of uncertainty around that and what the ultimate impacts are. I think generally the market hates uncertainty, right? So they'd rather know bad news than not know the news at all. So while there could be some volatility if these runoffs in Georgia get close, I think the market has took some kind of what's the right word? Took a little bit of a pause and is feeling pretty good about the likelihood of a split government and maybe some of the tax policies and COVID policies and whatnot that we heard from the Biden administration maybe not be able to be pushed through as quickly or as dramatically as the way it was spooking the market originally. And now you actually, the market responded positively to that and to the fact that they expect if the Biden administration is in fact in the White House, probably a higher probability of a fiscal package coming from that. So it's kind of interesting playing both sides of that and the market kind of benefiting as a result. And then from
hey, Michael,
Yep.
quick question for you. So typically, we just have to deal with the election and the ebbs and flows of the election. But given the enormity of the impact of COVID, and you saw what happened yesterday with the markets, given the announcement, of the vaccine potential, do you I know it's tough to know because none of us have kind of lived through this before, but do you think that the election results will have an impact on what we're seeing here in the markets to the extent that we continue to see good news out of COVID?
I think good news out of COVID will supersede the election stuff in the short term, Mac. I think some of the election stuff, the implications of that are on kind of earnings longer term, right? If corporate taxes go up, if some of that stuff gets pushed through, that stuff we're going to be talking about 2, 3, 4 years out from now. But I think, unless there's something crazy from a legal perspective around this election, like they really do find meaningful fraud or this thing gets pushed out and actually goes to the Supreme Court, as long as that doesn't happen, I think anything positive out of COVID and eliminating the possibility of a nationwide lockdown either now or into the future supersedes that, is how we would kind of view it. From a viewpoint perspective, we didn't change the bubbles again this quarter, still neutral given that layer of uncertainty. We don't want to have a big bet in the portfolio. We still favor value again, which I mentioned has been a headwind, but still feel strongly that that's the best way to be positioned looking forward. And then while this credit bubble is maybe not as exciting as it was last time we spoke, we still want to try to get some incremental yield out of that fixed income portfolio because rates are so low. So that's really where and I'll touch on how we're positioned that way when we flip over the next couple pages. So I'll pause there. Any other questions on markets in general?
Nope, not for me.
Okay.
I'll wait till the end, Mike. Thanks.
Okay. So on the long-term side, we ended September about 11.6 million. We were a little bit underweight fixed income, which we're comfortable with, a little bit overweight on the equity side as a result, but within policy targets and ranges. You'll see for the quarter, pretty strong results for the portfolio. Net of all fees up 5.7%. That's on top of a good second quarter. Still have a little work to do to make up for the lag in the first quarter when the market was just on its head, but generally, and that's kind of bled into some of these shorter term numbers, but generally we think things are trending in a good direction. Really, the returns were pretty positive across the board. Domestic equity has continued to be an area where we've been a little bit behind because of that value bias. You can see fixed income, because we've had that spread tilt, you'll see was well ahead of the ag in a period where rates were flat. MetWest, BlackRock, and Brandywine all adding meaningful value to that side of the portfolio. So that allocation we're pretty happy with, really behaving as we would expect it to behave. The domestic equity side, you can see, is held in okay historically, but year to date has been, a tough allocation. I think I guess the primary driver of that is that it is tilted toward value. We have meaningful exposure to the S&P 500 index and some of those tech names, but the active tilts we have in the portfolio are tilted toward value or toward managers that are going to have a valuation focus on their portfolio construction. So you can see Diamond Hill has actually been phenomenal in terms of its peers. Number one this quarter and really top decile across the board, but on a year-to-date basis, down 8 versus the Russell 3 up 5.4. That's a meaningful headwind. But Diamond Hill, again, we think is a great manager, and we're confident sticking with them. Boston Partners also on the value side and small cap side. That small cap value is a very worst place to be. So again, we have this posture in here. It's performing okay relative to its benchmark, but the general exposure has been a headwind. And then Eaton Vance, Atlantic Capital. Atlantic Capital is a growth mandate. So you'd say, okay, we'd expect them to do very well, but they're a quality growth mandate with a deep valuation bias. In small cap, what's worked has been the most expensive companies and the companies that have never generated an earning. They're all speculative around some of the biotech and vaccine stuff. They don't own any of that stuff. So you can see how big of a headwind that has been to them here in this short term. Dramatically underperforming the benchmark. You might say, again, why are you sticking with these guys? And it's because they haven't changed their approach. This is going to flip at some point. And the last thing we want to do right now is kind of chase what has worked of late. And actually, if you look out to the since inception number, since we've owned them, even though they're behind so dramatically in this really tough period, they're really generally in line or just modestly behind the benchmark since you've owned them. So it wasn't too long ago that they were a really big addition to this portfolio and a very strong manager. So one that we're kind of, as much as it hurts to own them right now, one that we're willing to hold on to and pretty confident that we'll be rewarded for that longer term. They've had periods like this in the past that we're pretty comfortable with. So we'll continue to keep a close eye on them and make sure they're not kind of changing and chasing what we don't want them to chase. But at this point, we're still maintaining that posture. The international side has been better. The returns here have been quite strong, really across the board. MFS and Dodge & Cox have both performed well. Dodge & Cox had a bit of an off quarter, but generally both the managers have been contributors. Templeton on the small cap side has been a contributor, and then Schroders has been a very consistent EM mandate. So while there's been a little bit of near-term headwind in the domestic side, the international side has been quite strong and offset that to an extent. And then a number of the changes we made on the alternative side have been additive as well, and you can see well ahead for the quarter, year to date, in 1 year period. So I'd say in summary, the domestic equity allocation with those postures has been tough, but we're confident in it and we're going to stick to it. And we don't see it here in a month and a half as a short-term period, but generally those postures have been rewarded this quarter thus far. They certainly have a way to go, just given how much growth has outperformed this year. But we think it's a prudent way to go about things going forward based on the longer-term strategy and trying to smooth the ride over a longer-term period. So I'll pause there on the actually, let me just comment one more thing on the long-term pool. So here you can see the flows for the quarter. So this PIMCO strategy, that's the high yield strategy that we put on. It was about a 2% weight in the portfolio. Again, it was up about 9% as spreads tightened in, and we decided to take those profits and we actually diversified those back across the other remaining fixed income allocations in the middle of August after we took those gains. So just an example of, that's the type of small tactical trade that we'll make. It's not going to be huge. It generally will only do it when we think there's a tremendous opportunity. And historically, and we touched on the last quarter, when spreads gap out like that, it tends to be a pretty good opportunity to do that. So we didn't expect it to go that quick, but we'll take those type of trades when we can implement them without making big bets in the portfolio as we move forward. So I'll now pause on that and just see if there's any questions on this construction or the managers that I can address.
Less question and more comment. So I like what you just said about the active management. Making some changes when you think you can take advantage of an opportunity. So it's good to know that I know that there's we looked at our size relative to others in terms of dollar value, but knowing that we're certainly a high on a totem pole in terms of customers is good to hear. So I appreciate the active management of our account.
Okay, thanks for that, Mac. And if there's nothing else, we'll go to the short-term pool. Short-term pool has actually been very strong, both absolute and kind of what it's supposed to do in this type of very choppy environment, right? It's designed to be preservation of capital and earn us a return above money market. And so you can see year to date, it's up 2%. And 2.4, the benchmark is a little bit diversified, and this is net of our fee. So our fee is going to be, I think it's small, it's less than 20 basis points, but it's going to impact this pool more than the long-term pool, just because the returns are going to be more muted. But here you can see generally the returns of that pool. I don't know why this benchmark is in here. That is a glitch in the report. It shouldn't be that benchmark, but regardless, we don't have that much duration exposure in here. But let's look at the underlying exposures. So Payden, which has about a third of a year duration, so basically acting as a money market, but very active on the kind of short end of the curve, up 1.3%. Our socially responsible bond portfolio, that acted as a nice benefit in with rates dropping as dramatically as they have. So a little bit behind the ag, but generally holding in there okay, and has bounced back in the quarter. And then that Vanguard short-term piece as well. So I think everything here behaving as we would expect it to. And ultimately, right, this is what we want to see, is a return that trying to maximize a return where we can without taking any undue risk, and certainly better than you can get in money market as it sits today. So continue to keep a close eye on it, because I know it's important, particularly this year, if we're going to keep the 4.5 to 5 million in it. But as it sits today, pretty comfortable with the postures and right on the policy statement as well.
For Mike and Mac and Tony, I always look at that TIAA. I mean, I feel like it's a lifetime ago when we made that small social choice preference there. And it's good to know it's at least working during a pandemic.
When I see that, I think of you. No, you're right. Spot on. It's good to see it's continuing to perform well.
Yeah.
Other than that, Mac, unless there's any questions, that was kind of everything through our normal reporting discussion.
Yeah, I mean, no other question from me. I mean, it's as we all know, it's volatile times right now, and it looks like through all that, we're in a good spot. Again, the active management is certainly important to me. And also being able to every quarter kind of focus on different areas of the overall engagement. Governance being the focus. This quarter, I think is important, right? And to your point, anyone who wants to kind of read through that, kind of stay up on kind of where we're at and why we're doing what we're doing. Certainly read through that. I know Maurice, I don't think is on the call yet, ors at all, but to the extent we get, oh, there you go. Hey, Maurice.
Yeah.
I know you jumped on late, good to see you, but certainly, feel free to go through the document and certainly ask any questions. But again, from my perspective, it looks like, things are holding together, very well. Just the overall structure of the long and short-term accounts are playing out the way we would like. Again, and that active kind of taking advantage of opportunities where you can, without making a complete major changes to kind of the philosophy is certainly that I'm liking and want to continue.
I would offer, Mike, that when we meet next quarter, and I also just want to walk around a couple things and see if you can't help us when we meet again in a few months. To Mac's point about active management, forecasting, right, is at such a premium right now, even though it's so hard and things are so uncertain. We had the conversation yesterday with our Ways and Means Committee. It's not by accident that cash flow at the college is different now. And that, Mac, as you saw, the rise and the falls are a little less. That's, again, by a lot of work by Dorothy, by Jason, by Ed, by us really trying to be more diligent in terms of trying to round out the edges of some of these rises and falls. For me, Mike, it's almost feels like look into your crystal ball. But when we meet next quarter, help us try to navigate what maybe a vaccine is looking more likely to do to investments. And even this idea of, I hear you around when there is different parties in different roles, how that might be favorable in the markets, but it may be unfavorable in terms of a stimulus that then states have that they can pass along to us, because the college is grappling with some real significant IT and facilities needs right now. We're having some great conversation with trustees about where and how we might spend some of these dollars. But it's all sort of up in the air about, well, if all of a sudden there's a windfall and higher education gets a little bit of a bailout, there's now a way to sort of reshuffle the funding source, if you will. So trying to really telegraph that and sort of look ahead for us means not only is this an important year, but we're already talking about fiscal year 2022. And that seems really tough to nail down. But maybe, again, in another 3 months or so when we meet again, it helps to kind of map, especially because this is our insurance policy. These dollars right here are really the bedrock for us when it's been really bad in the past. So the question is not just operationally what the college may need, but I mean, we're talking some of the functionality of the college. I mean, 315 million, right, is always the number that I put out there. That's a significant dollar amount on your campus with some real buildings that are in tough shape. So the idea of go, no go on some of these, I think it helps to sort of buffer that with what's the status of our portfolio. Okay.
Yeah, we can do our best with some of that. I mean, some of the stuff is, you're right? It's not just stimulus impact on the market and how it responds in the near term, but how that actually ultimately trickles down to, what groups would receive that, how it can go to support your broader mission. So we'll do what we can to try to dig into that a little bit more and pinpoint that. I think from the vaccine side, right? If we get a vaccine that can be distributed as quickly as Pfizer claims that can be, and as effective as it is, I mean, you'll see the markets respond very favorably, and the cyclical out of favor names like we saw yesterday are going to be the ones that come back extremely quick in a short-term period of time. I think the harder thing to predict is like what happens after that kind of first 2 week or month, shot in the arm on how it ultimately plays out, right? Because there's still a lot of businesses that are, even with a vaccine, have been kind of on the ropes and are close to being able to sustain themselves, even if we move into a much better economic picture. So we'll continue to work on both those, and we'll do what we can just to give you some additional insights into what's going on that stimulus piece in terms of supporting educational institutions specifically.
Appreciate it. Thanks.
Any other questions, Mike? Okay. I guess with that, Mike, thank you very much for another great update. Always look forward to seeing you. Except for the fact that another 3 months have gone by. But besides that, it's always a pleasure. Appreciate your updates. It's always very thorough, and certainly appreciate those as we continue to move forward, especially as we see the volatility in the markets. So I appreciate that. So Danae, I'm not quite sure if we need to take, well, I guess we do have to take a roll
Yes.
to
To adjourn.
adjourn the meeting.
Yes.
If you wouldn't take us through?
So, yes, Max Starks,
Yes.
Maurice Lindsay,
Yes.
and Mary Kate Mirren. Yeah. Thank
Okay. Great. With that, thank you all very much and have a great evening.
Thanks, everyone.
you. Thank you.
Okay.
You
Thank
too.
you. All right. See ya.